Financial asset prices rise and fall for a variety of reasons. Here are 7 sources of risk which affect the value of an investment. The first of these is interest rate risk. This is where investments may make losses due to a change in interest rates. If interest rates rise in an economy, this increases the opportunity cost of holding other assets. Higher interest rates elsewhere mean you could be making more money by holding different assets. Bond prices thus move in the opposite direction of interest rates. Business cycle risk is the risk of investments making a loss due to the business cycle. The economy doesn't grow in a linear way, but rather moves in cycles. We see periods of strong economic growth followed by stagnation and recessions. Recessions often cause poor market performance, with many investments falling in value due to uncertainty and companies having lower profits. However, some assets will rise in value during recessions, such as companies selling cheap necessity goods that have higher demand in times of economic hardship. Macroeconomic risk is where asset values may change due to shocks to the economy. Any assets that are exposed to a particular economy may be affected by changes to that economy. For example, if there are changes to tax policies, government spending, or commodity prices, domestic assets may be affected. But the asset doesn't have to be physically in the economy or listed on its stock exchange to be exposed to macroeconomic risk. UK stocks may be heavily impacted by what happens in the USA because UK companies rely on the US as an export market. Political risk refers to the risk of investments falling in value due to instability or political changes in a country. If there are wars, civil unrest, and the risk of a country's government being overthrown, financial assets based in this country will usually fall in value. This is because a new authoritarian regime may seize assets or implement new regulations which harm business profits, such as putting bans on foreign trade. Industry risk is where factors particular to a specific industry may affect the performance of assets within that industry. Assets within the same sector of an economy are usually strongly correlated. For example, specific taxes or regulations may be focused at the energy industry in order to reduce climate change. Changes to trade agreements will also have a larger impact on industries that rely more on exports. Next up is exchange rate risk. If an investor holds foreign investments, returns will be affected by how the domestic currency fluctuates against the foreign currency. For example, if the domestic currency increases in value, this will reduce the investor's returns on foreign investments, purely because of a change in the exchange rate. Finally, we have liquidity risk. This is the risk that a business cannot pay off its short-term debt obligations. Some investments may be difficult to sell or buy quickly. If you hold lots of these investments, it may be difficult to pay off any short-term obligations. You may end up having to sell your investments at a huge loss in order to raise funds to pay off short-term debts. This means companies that don't have much cash have higher liquidity risk. You can see each of these risks discussed in more detail in individual videos. Here is the first one covering interest rate risk.